Hello class, welcome to Module 6. There are many consumer protection laws that protect your rights as a consumer, and knowing your legal rights can help you protect your money. This module will give us general information on the laws and regulations that protect our rights as consumers and will help us guard against identity theft and financial abuse. After completing this module, you will be able to recognize how federal deposit insurance protects deposits, recognize how to guard against identity theft, and recognize signs of financial abuse. Let's get started with a discussion of federal consumer protection laws and regulations that protect deposit accounts. There are many federal consumer protection laws. In fact, there are too many to cover in this module. However, you should know that financial institutions must follow certain laws and regulations that protect your rights as a consumer. We will begin by looking at 4 laws that protect you with regard to deposit accounts. First, the Truth in Savings Act. The Truth in Savings Act requires financial institutions to disclose the terms and conditions of bank accounts clearly and in writing. Some of the required information that a bank must disclose include interest rate information, balance requirements, fee information. Because of this law, the bank must send you statements for your accounts periodically and provide account information to you at any time you ask for it. This allows you to shop for the best account and make informed decisions before opening a deposit account. For example, if you telephone a bank and ask for interest rates on deposit accounts, the bank must state the annual percentage yield, APY, that reflects the effects of compounding. You can use the APY when making comparisons among different savings accounts. Let's get started with a discussion of federal consumer protection laws and regulations that protect deposit accounts. There are many federal consumer protection laws. In fact, there are too many to cover in this module. However, you should know that financial institutions must follow certain laws and regulations that protect your rights as a consumer. We'll begin by looking at 4 laws that protect you with regard to deposit accounts. The Truth in Savings Act. The Truth in Savings Act requires financial institutions to disclose the terms and conditions of bank accounts clearly and in writing. Some of the required information that a bank must disclose include interest rate information, balance requirements, and fee information. Because of this law, the bank must send you statements for your accounts periodically and provide account information to you at any time you ask for it. This allows you to shop for the best account and make informed decisions before opening a deposit account. For example, if you telephone a bank to ask for interest rates on deposit accounts, the bank must state the annual percentage yield, the APY, that reflects the effects of compounding. You can use the APY when making comparisons among different savings accounts. Expedited Funds Availability Act. The Expedited Funds Availability Act, EFAA, limits the amount of time a bank can hold a check deposited into your checking account. FDIC Deposit Insurance Regulations. The Federal Deposit Insurance Corporation, the FDIC, deposit insurance regulations protect your money if a bank fails. However, the FDIC does not insure non-deposit investment products, including stocks, bonds, mutual funds, and annuities. If you have any questions or problems with your deposit account, write a letter to your financial institution. If you do not receive a response, contact your bank's regulatory agency. If you're banking with an FDIC-insured institution, your deposits are protected. The FDIC insures funds and deposit accounts within FDIC-insured institutions, including checking, savings, money market deposit accounts, MMDAs, and certificates of deposits, CDs. As I'd mentioned, FDIC does not, however, cover other financial products and services that insured banks may offer, including stocks, bonds, mutual fund shares, life insurance policies, annuities, and municipal securities. By law, federal deposit insurance is backed by the full faith and credit of the federal government. If a bank fails, the FDIC will pay all insured deposits up to the insurance limit, including principal and any accrued interest through the date of the bank closing. Federal law requires that all insured deposits be paid as soon as possible. Deposit insurance coverage is based on a depositor's ability to meet the specific requirements for an ownership category. The most common account ownership categories for individual and family deposits are single accounts, joint accounts, revocable trust accounts, and certain retirement accounts. Each ownership category has different requirements, and the potential amount of insurance coverage for each category is based on the standard maximum deposit insurance amount, the SMDIA. The current SMDIA for each ownership category, which we will discuss in more detail later, is as follows. Single accounts owned by one person, $250,000 per owner. Joint accounts owned by two or more persons, $250,000 per co-owner. Individual retirement accounts, IRAs, and other certain retirement accounts, $250,000 per owner. In revocable trust accounts, each owner is insured up to $250,000 for the interests of each different beneficiary, subject to specific limitations and requirements. If you and your family have the SMDIA allowed by law or less in all of your deposit accounts at the same insured bank or savings association, you do not need to worry about your insurance coverage. Your deposits are fully insured. You may qualify for more than the SMDIA at one insured bank or savings association if you own deposit accounts in different ownership categories and specific requirements are met. Periodically review your coverage if you have close to or more than the SMDIA at one institution. For additional details on the coverage limits, requirements, and in-depth information on all account ownership categories and other types of deposit accounts, visit www.fdicinsurance.gov/deposits/deposits or call 1-877-ASK-FDIC, or you can talk to your bank representative. To calculate insurance coverage, you can use FDIC's electronic deposit insurance estimator located at the FDIC website. Now we'll review some additional information about the main ownership categories. A single account is a deposit account owned by one person and titled in that person's name only, with no beneficiaries. All of your single accounts at the same insured bank are added together, and the total is insured up to the SMDIA, currently $250,000 per person. For example, if you have a checking account and a CD at the same insured bank, and both accounts are in your name only, the two accounts are added together and the total is insured up to $250,000. Note that retirement accounts and eligible trust accounts are not included in this ownership category. Here's a question for you. If you have $500 in a savings account and $1,000 in a checking account and the bank fails, are you insured by the FDIC for the full amount? Yes, the FDIC will cover all of your single accounts at the same insured bank up to $250,000. A joint account is a deposit account owned by two or more people entitled jointly in the co-owner's names only, with no beneficiaries. If all co-owners have equal rights to withdraw money from a joint account, a co-owner's shares of all accounts at the same insured bank are added together, and the total is insured up to $250,000 per person. So for instance, if a couple has a joint checking account and a joint savings account at the same insured bank, each co-owner's shares of the two accounts are added together and insured up to $250,000 per owner, providing up to $500,000 in coverage for the couple's joint accounts. So here's another question for you. If you're a co-owner of a CD totaling $5,000 and you have equal rights to the money as the co-owner, how much money would you receive from the FDIC if the financial institution failed? You would receive $2,500, or half of the money. Certain retirement accounts are deposit accounts owned by one person and titled in the name of that person's retirement plan. Only the following types of retirement plans are insured in this ownership category. IRAs, including traditional IRAs, Roth IRAs, simplified employee pension IRAs, and savings incentive match plans for employees IRAs. Section 457 deferred compensation plan accounts, whether self-directed or not, self-directed defined contribution plan accounts, and self-directed COG plans or HR 10 plan accounts. All deposits that an individual has in any of the types of retirement plans listed above and at the same insured bank are added together and the total is insured up to the SMDIA. For example, if an individual has an IRA and a self-directed COG account at the same bank, the deposit in both accounts would be added together and insured up to $250,000. I don't expect you to remember every detail about these accounts for any exams. I simply want to raise awareness about the coverage for various retirement accounts. A revocable trust account is a deposit account held as payable on death, POD, or in trust for, ITF, or one that is established in the name of a formal revocable trust, also known as a family or living or family trust account. POD and ITF accounts, also known as testamentary or taught in trust accounts, are the most common form of revocable trust deposits. An informal revocable trust created when the account owner signs an agreement, usually part of the bank signature card, stating that the deposits will be payable to one or more beneficiaries upon the owner's death. Living trusts or family trusts are formal revocable trusts created for estate planning purposes. The owner of a living trust controls the deposits in the trust during his or her lifetime. The trust document sets forth who shall receive trust assets after the death of the owner. Deposit insurance coverage for revocable trust accounts is provided to the owner of the account. The amount of coverage is based on the number of different eligible beneficiaries named in the trust, and in some cases, the interests allocated to those beneficiaries up to the insurance limit. An eligible trust beneficiary must be either an individual, regardless of the relationship to the owner, or an Internal Revenue Service, IRS, qualifying charity or nonprofit organization. Revocable trust coverage is based on all revocable trust deposits held by the same owner at the same bank, whether formal or informal. We've discussed the laws that protect consumers when opening and using deposit accounts. Now we'll discuss how to protect your non-deposit investment accounts. The FDIC does not insure non-deposit investment products, including stocks, bonds, mutual funds, and annuities. It only insures funds held in deposit accounts at FDIC-insured banks up to the maximum amount allowed by law. So for instance, let's pretend Robert has a $10,000 CD from a bank. He also invested $10,000 in a mutual fund with a broker at the same bank. The mutual fund lost value, and although this rarely happens, the bank failed. The FDIC will cover Robert's $10,000 for the CD and any interest he's earned because it's less than $250,000. Neither the FDIC nor the Securities Investor Protection Corporation, the SIPC, will cover Robert's mutual fund or protect him from the rise and fall of market value. So how can you protect yourself? Have enough emergency money in a savings or other readily accessible account to support you and your family for at least 6 months before investing in non-deposit products. Do not use this money to buy investment products. Do your homework. Never invest in a product you do not understand. Gather information before making an investment and ask questions until you're satisfied. Attend classes, seminars, or check the business reference section of the public library to become better informed. Understand the risks before investing. Investments always have some degree of risk. Be sure your sales representative knows your financial objectives and risk tolerance. Take your time when making investment choices. Do not rush to invest and be careful of act now or before it's too late statements. And lastly, keep good records. Retain and maintain account statements and confirmations you receive about your investment transactions. So how can you protect yourself? Document all conversations with brokers. Take immediate action if you detect a problem. Time is critical, so do not be afraid to complain. Make checks payable to a company or financial institution, never an individual. Invest wisely online and offline. Be wary of investment scams. Now we'll take a look at the requirements of the laws designed to protect your privacy. Let's talk about privacy. The law requires 1. Financial institutions to protect your financial information. 2. Companies that are involved in financial transactions to send you privacy notices. Privacy notices explain how the company handles and shares your personal information. In particular, these notices explain what information the company collects and how you may be able to limit the company's sharing of your information with others. You may have already received a privacy notice from a financial institution. The types of privacy notices include initial privacy notices, which are required when you open an account or become a customer of a financial company. Annual privacy notices, required once a year from each financial company you have an ongoing relationship with. And then notice of changes in privacy policies, which are required if a company changes its privacy policy, and the changes are noted in the next annual privacy notice. Financial companies share information to, number 1, offer you more services, 2, introduce new products, and 3, profit from the information they have about you. If you prefer to limit the promotions you receive or do not want marketers and others to have your personal financial information, you must take some important steps to opt out. Federal privacy law gives you the right to stop or opt out of some of the sharing of your personal financial information. You can opt out of most, but not all, information sharing with other companies. For example, the law permits a financial company to share certain information about you without giving you the right to opt out. The company might give your information to firms that help promote and market products offered by the company itself or jointly with another company, to firms that provide data processing and mailing services for your company, when a court orders it to do so, and to credit bureaus about your payment history on loans. Information about your relationship with a company may also be shared with companies that are jointly owned or affiliated with that company. If you opt out, you limit the extent to which the company can provide your personal financial information to non-affiliates. If you do not opt out within a reasonable period of time, generally about 30 days after the company mails a notice, the company is free to share certain personal financial information. If you did not opt out the first time you received a privacy notice from a financial company, it's not too late. You can always change your mind and opt out of certain information sharing. Contact your financial company and ask for instructions on how to opt out. Remember, your right to opt out does not apply to the personal financial information shared before you opted out. In addition, you can call a toll-free number to opt out of receiving most pre-approved offers of credit or insurance. To opt out, call 1-888-5-OPT-OUT, that's 567-8688, or visit www.optoutprescreen.com. Now that you know the laws and regulations that protect you, we'll discuss a topic that I know you're eager to learn more about: identity theft. What is identity theft? Identity theft occurs when thieves steal your personal information, such as your social security number, birth date, or credit card numbers. With sufficient information, another person can become you and use your identity to commit fraud or other crimes. Identity theft is a serious problem, and here's why. Despite the efforts of law enforcement, identity theft is becoming more sophisticated and the number of new victims is growing. If the crime is not detected early, you may face months or years of cleaning up the damage to your reputation and credit rating. You may even lose out on loans, jobs, and other opportunities. Let's talk about some common forms of identity theft. Phishing and farming are common forms of identity theft. Phishing is when criminals send out unsolicited emails that appear to be from a legitimate source, perhaps from your bank, utility company, well-known merchants, your internet service provider, or even trusted government agency, example, the FDIC, and they attempt to trick you into divulging personal information. Farming is similar to email phishing as follows. Criminals seek to obtain personal or private information by making fake websites appear legitimate. Your browser will even show that you are at the correct website. This makes farming more difficult to detect than phishing. Also be careful of skimming. This is when criminals steal credit and debit card numbers by using a special storage device when processing your card. Let's talk about how you can avoid identity theft. Number 1, protect your social security number, credit card and debit card numbers, personal identification numbers, passwords, and other personal information. Protect your incoming and outgoing mail. Locked mailboxes are great. Sign up for direct deposit. Keep your financial trash clean. Shred, shred, shred. Keep a close watch on your bank account statements and credit card bills. Avoid identity theft on the internet. Never provide a bank account or other personal information in response to an unsolicited email or in visiting a website that does not explain how personal information will be protected. Review your credit report annually and report fraudulent activity. Get more information. Visit the FTC at www.ftc.gov/ID-theft or call 1-877-ID-THEFT. That's 438-4388. If you believe you are a victim of identity theft, the FTC recommends you immediately take the following actions. File a report with your local police. Get a copy of the police report so you have proof of the crime. Contact your creditors about any accounts that have been changed or opened fraudulently. Ask to speak with someone in the security or fraud department. Follow up in writing and include copies of supporting documents. Keep records of your conversations and correspondence. Use the identity theft affidavit at www.ftc.gov/idtheft to support your written statement. File a complaint with the FTC using the online complaint form, or call the FTC Identity Theft Hotline. Ask for verification that the disputed account has been closed and that fraudulent debts discharged. Finally, call the FTC's Identity Theft Hotline at 1-877-ID-THEFT. That's 438-4338. Or visit www.ftc.gov/idtheft. Fraud alerts. If you suspect you've been a victim of identity theft or think you're about to be, for example, if your wallet was stolen, contact the fraud department of any of the 3 credit reporting agencies. The agency you call is required to notify the other 2 credit agencies. Tell them you're an identity theft victim or potential victim. You have the right to place an initial fraud alert in your credit file. You can do this by calling, writing, or visiting any of the 3 credit reporting agencies online. This initial fraud alert will last 90 days. If you know you're a victim of identity theft, you may have an extended fraud alert placed in your credit file. The extended fraud alert requires a lender to contact you and get your approval before authorizing any new account in your name. The fraud alert is effective for 7 years, the extended fraud alert. To place an extended alert in your credit file, submit your request in writing and include a copy of an identity theft report filed by a law enforcement agency or with the U.S. Postal Inspector. You can get a free copy of your credit report if you ask when you place a fraud alert on your file. Active duty military personnel have the right to place an alert in their credit file so that lenders acting on loan applications can guard against possible identity theft. Security freeze. Many states have laws that allow you to place a security freeze on your credit file. A security freeze restricts potential creditors and third parties from accessing your credit report unless you authorize the release of the security freeze. Be aware that using a security freeze to restrict access to your credit report may delay, interfere with, or prohibit the timely approval of any subsequent request or application for credit. State laws vary, and there may be a charge to freeze and unfreeze a credit file. The cost of placing temporary lifting and removing a credit freeze also varies. Many states make credit freezes free for identity theft victims, while in other states consumers must pay a fee, typically around $10. For more information, please visit www.ftc.gov. Your personal and financial information can be as good as cash to a criminal, so take identity theft seriously. Start by following these simple suggestions for keeping your sensitive information secure. What would you do if your wallet or purse were lost or stolen? If they were stolen, the FTC suggests you file a report with the police as soon as possible. Keep a copy of the report in case your bank or insurance company needs proof of the crime. Cancel your credit cards immediately. Get new cards with different numbers. Place a fraud alert on your credit report by calling any of the major credit reporting agencies. Equifax, 1-800-525-6285. TransUnion, 1-800-680-7289. Experian, 1-888-397-3742. Report the loss to your bank. You might want to open new checking and savings accounts and stop payment on any lost checks. Contact the major check verification companies to request that they notify all stores that use their databases not to accept your lost checks. You can also ask your bank to notify the check verification service with which it does business. 2 of the check verification companies that accept reports of check fraud directly from consumers are Telecheck and Certegy. Certegi. And lastly, request a new ATM card with a new number and password. Another serious problem you should be aware of is financial abuse. What is financial abuse? Financial abuse is occurring at an alarming rate. It involves using a person's money or assets contrary to his or her wishes, needs, or best interests for the abuser's personal gain. We'll review some examples of financial abuse, including who the perpetrators are, who's at risk, which indicators identify that abuse is occurring, and what can be done to prevent it. Examples of financial abuse. Financial abuse covers a wide range of acts that involve committing fraud against people through the use of deception, trickery, false pretense, or dishonest acts or statements for financial gain. Particular examples include taking money or property, forging a person's signature, getting a person to sign a deed, will, or power of attorney through deception, coercion, or undue influence, using the person's property or possessions without permission, promising care in exchange for money or property and not following through on the promise, and using telemarketing to commit scams against people, including perpetrators calling victims and using deception, scare tactics, or exaggerated claims to get them to send money, or perpetrators making charges against victims' credit cards without authorization. Potential perpetrators of financial abuse may include family members, such as children, grandchildren, or spouses who have substance abuse, gambling, or financial problems, stand to inherit and feel justified in taking what they believe is almost or rightfully theirs, those who fear that their family members will get sick and use up their portion of savings, depriving the abuser of an inheritance, those who have had a negative relationship with a person and feel a sense of entitlement, those who have negative feelings towards siblings or other family members whom they want to prevent from acquiring or inheriting a person's assets. Telemarketers may also seek out people who are more trusting of investment or charity schemes as well. Who's at risk? The following conditions or factors increase an in-person's risk of being victimized: isolation, loneliness, recent losses, physical or mental disabilities, lack of familiarity with financial matters, ties to family members who may have substance abuse problems. Who can help? There are 2 local agencies who can help. If you're not in the Boise area, I encourage you to seek sources in your community: the Boise Women's and Children's Alliance, and the 211 Idaho Care Line, a free statewide community information and referral service, a program of the Idaho Department of Health and Welfare.